Hello, everyone. I'm Kirsten Korosek, and today we'll be hearing from Jake Saper on the topic of when it comes to fundraising, timing is everything. And honestly, right now, I cannot think of a better time to be talking about fundraising. Jake comes from Emergence Capital, where he is a partner and serves on a number of boards, including Textio, Guru, and Ironclad. And so welcome, Jake.
Thank you.
And
Glad to be here.
before we get into the presentation, I just want to remind everyone, please get ready to ask some questions, but use the Q&A function, not the Zoom chat function. We will not be monitoring that for questions. And so we'll get as many questions as we can. Please don't be shy. With that, Jake, I'm going to hand it over to you and take it away.
Thank you, Kirsten. And thank you to the TechCrunch folks who put this together. Excited to be part of it. And thank you to those who are joining to chat about it. And as Kirsten said, please put as many comments as possible in the chat, as she said, and we'll go through it. So I will start by sharing my screen. I'm going to figure out how to do this. If I didn't know how to do this, it would be depressing. We're the largest investors in Zoom, so I should know how to use this product effectively. Let's see if I can. There we go. All right. All right. As Kirsten said, the purpose of the talk today is to talk about fundraising timing, figure out when you should raise effectively and how you should time that. So I'll give you a quick overview of myself, very quick on the firm, and then we'll dive into the content. So on myself, as I'm, I guess, originally from Austin, Texas. I am a singer and a very mediocre guitar player that comes from Austin's music scene. I am a dad, relatively recent dad. This is a picture of my daughter, Sadie. And I'm a partner at Emergence, as Kirsten said. And I sit lucky to sit on a number of boards. Most of these companies, we led the Series A. And that's just some important context when we think about timing fundraising. I'm primarily going to be talking about timing your Series A fundraise. A lot of the stuff is actually applicable to timing other fundraisers as well, but that's kind of where we tend to spend most of our time. I'm also going to talk to you a bit about Emergence quickly, and I'm going to do it in the context of our values as a firm, because I think that'll also help you anchor the perspective we have around fundraising timing. So these are our firm's values. All of them start with we all. We all focus to drive conviction. All we do at Emergence is focus on B2B software companies. So all of us, all we do is B2B software. And we do that because we want to invest with conviction in the companies that we're backing. So we don't do small bets. We generally lead almost all of our investments. So that will inform a bit on my fundraising timing comments. We also strive to be your most important partner, you being the founders that we work with. There's 6 partners in our firm, and each of us on average makes 1 investment per year. So the idea is we really go deep and try to help you succeed. So that, again, will help kind of inform how we think about fundraising and timing. And then lastly, we win big in the long run. So we think a lot about, partnering with companies over a very, very long period of time. And I'll talk to you a bit actually about timing in terms of board relationships and how important that is when you think about fundraising timing as we move on. So that's our firm. Let's talk about what we're going to talk about today. So when they asked me to talk about fundraising timing, I realized there's 2 angles to think about. The first is kind of the macro questions around, independent of your company, when is a good time to raise, just from a calendar perspective? So we'll start with that topic. We'll obviously touch on COVID. And then we'll dive in and spend most of the time on micro timing. Specifically for your startup, when does it make most sense to raise? So these are some of the questions that we'll go through. So let's start with macro. What's the best time of year to raise a round? And specifically, again, I'm thinking about Series A, but the reality is this is probably applicable more broadly for most rounds. The reality is people are raising at all different times of the year, but if you look at a proxy, one proxy is when are people looking at pitch decks? How actively are looking at pitch decks? You can look at DocSend, which has kind of collected a bunch of data on this. And here's some data from DocSend on when pitch books are viewed by VCs. And so this is kind of a metric on visits per deck that are sent out by entrepreneurs by month. And so you can see that there are 2 clear peaks in when people are viewing these decks, January and February being by far the most common or most active deck viewage and then September being second most common. And this kind of fits anecdotally with what we see. I think generally speaking, founders kind of spend a lot of December kind of getting prepped for a big launch and fundraise in January and February. Generally, VCs are back from whatever they've been doing, and that is a big push and kind of a common time to get everyone's attention. Now, you're also fighting for people's attention more because other people are fundraising, but generally people are feeling hungry and really running after deals at that point. Same thing goes with September, where often founders will use kind of the summer months to prep a fundraise that launches in the fall. I'll talk more in the micro section about how this may have nuance for your specific startup, but this is just some anecdotal data or rather my data is anecdotal to pair with the DocSend data around kind of calendar timing. How has COVID impacted this? Well, I think what's been really interesting is that when COVID first hit in March and April, there was a big thaw, right? People were focused on kind of internal portfolio triage. I think companies were also themselves focused on triage and less on fundraising. But what's happened is that there's been a real resurgence in fundraising. And it's too early to show you kind of closed deal numbers, because often there's a lag between when the fundraise closes and when it's announced. So I think the data on that is still a little bit early to show, but PitchBook, or rather DocSend, has put together some data around pitch interest over the calendar year and how it compares to previous years. And that's this chart. So if you look at the green line, which is 2020, you can see that there was kind of a decline in pitch deck interest around March and April, although it didn't decline drastically. And then it's climbed, and it's actually higher than it has been in previous years during the summer. And what's interesting is, it'll be interesting to see, you can see the slope of the curve that's ending right now. It'd be interesting to see, is that continue to peak? And is this going to be a season where summer is actually more active than it typically has been for fundraising, potentially because founders didn't raise earlier in the year, or because they're feeling more confident now, or perhaps because they need money. But this is a weird year. I think another thing to note is that the vacation schedule is obviously thrown off because people are limited in what they can do. So people are generally around more and working on Zoom. So even if they are not in their place of residence, they could still, obviously make investments over Zoom, as we ourselves have now done. We made our first investment in a founder and a team that we had never met in person, exclusively over Zoom, a few weeks back, and have built that muscle and are excited to continue to do it. So it's a weird year, but it seems like there's a lot of appetite to invest. So keep that in mind as you're thinking about fundraise timing. So let's move to the micro. So you've raised your seed round. Again, we're thinking about this kind of in that context. What do you do next? And I have this, it's kind of a cheeky comment here. It's time to start raising the A. And the reality is, like, there is some truth to this, for better and for worse. So you've closed your seed. What do you do next? Obviously, the focus should be product and customers, but you do need to start thinking about back solving for the Series A, even once you close that seed. And so I want to talk to you a bit about what that back solving process should or could look like. So this is a fun question mark fact / depressing fact. The average board relationship lasts longer than the average American marriage. The data on this, there's lots of different ways to interpret this data, but this is I think directionally true and also super depressing. But the reason I bring it up is not to depress you. I bring it up because it shows the importance of choosing your board members, right? It's really, really, really important to get to know the people that you're bringing onto your board, because they're likely to be working with you for a very long period of time. And it's really hard to fire them. So I think one of the challenges that's taken place as fundraising has become more of a pack it into a super tight period, get to know, a long list of people, have many conversations quickly, and then make a decision. Neither party really gets to know the other well enough to know, is this a relationship I want to enter into? Because ultimately, life is short. You want to work with people that give you energy. And this is why I strongly encourage you to start to get to know potential Series A leads shortly after you close your seed round. And I'll talk to you a bit about how you can do that. So here's some tips on how to do that effectively. The first is just identify a handful of potential A leads that are suited to your business. So if you're building a consumer software company, then focusing on, someone who's done a lot of Series A consumer investing is probably going to be a good decision, because they're going to have pattern recognition and teach you, what they've seen in the past. They're going to know the right people to help you hire for your given function, and vice versa. As I said, all we do is focus on software companies, business software companies, and we have a lot of perspective on what a go-to-market model should look like for those types of businesses. How do you think about bottoms-up growth versus tops-down? Who should you hire from a sales leadership perspective, marketing leadership, et cetera? So just get a handful of folks that you think would be well suited to your business, and then vet them with your seed investors. A really important role that seed investors play is to help you get to know and vet potential Series A leads, because they play the game over and over again, right? They have lots of companies that go and meet with Series A leads, and so it's important that they give you advice and give you candid feedback on, hey, this is what this team is like to work with. This is like what she's like to work with, et cetera. And then lastly, meet these people periodically. Take time to meet them. And ideally you work on something together. These people being, potential handful of potential Series A leads. Work on something together. And, personally, as a Series A lead myself, I love doing this with people. Like, I love it to be not just to get to know you, which is important, but also like something substantive where, hey, we're working on your pricing strategy together, where you've got this existing per seat user model and you're starting to think about other pricing models, and you want to, have a working session on that. Or you're looking to hire your first AE and you want to brainstorm what profiles could look like. You want to go back and forth on a spec. You maybe want some ideas, or you want me to talk to someone that you're considering. It's a really substantive way for people to get to feel what it's like to work with each other. It's like a work sample almost. So I would encourage you to do that. You can't do that with a long list, which is why I say a handful, but do that with a handful of people and just understand what it feels like to work with them. And then ask yourself this critical question. And this question I'm going to state now is actually written on top of my computer screen, like in actual physical writing with ink and on a Post-it note, and it lives on my screen all the time. Because it's a question that I ask myself to make business decisions. It's a question I ask myself to make personal decisions. And the question is this: does spending time with this person give me energy? It's a really simple question, but the concept is, I have a certain amount of energy going into the conversation with a given person. I spend an hour with them, and I come out of that and I ask myself the question, like, am I feeling more energized, more excited, am I buzzing more coming out of the conversation than I was going in? Or is it the same, or is it less? And that is a really effective way to know, do I want to work with someone? Do I want to hire this person? Do I want to go on a date with this person? Do I want to, and I don't mean that in the context of fundraising, I mean, separately, this is something that's appropriate in life more broadly. And also, in the work context, do I want to consider them to be a board partner for me over time? So this phrase is something that has become a really clarifying phrase for me in my life. So I think it applies in lots of contexts, and hopefully this is useful. This came from a guy named Matt Moshari, who's a great CEO coach who taught this to us a few years ago. Okay, so that's the process of getting to know folks. Then the question is, when are you ready for an A? You, the startup founder. And the quippy answer I have for that is when you know how to spend the money, which is quippy, but also actually, I think, telling. The concept is when you have the product built out enough and you have an initial go-to-market motion built out enough that if you raise a Series A, I know exactly what I need to spend it on. I know that I need to scale up my AE staff. I know I need to hire these 3 engineers to build this new product feature. When I have a sense as to like what it will be used for, that's the moment you should raise. And the proxy for that is often this concept of product market fit, which is an admittedly subjective term. But I can tell you the definition that we use internally. It's a really, really simple one. Product market fit is when your target customers love your product and they're happily paying for it, right? So that, and love I've bolded here because I've made big letters. I forgot what the English word is for that. Because it's really important they love your product. That concept of like the VC having a conversation with your users and understanding people saying like, you'd have to rip this out of my cold dead hands, like, or I'll pay for this myself if the company stops paying for it. Those are the phrases that a VC wants to hear because they want to fund a product that has great passion behind it. And also this concept of happily paying for it. There's, one thing that can be tricky is if people love your product, but they have a very low willingness to pay, you may not actually have product market fit. And so it's important to understand both. When you've locked this in, you're at rough product market fit. and you're in a pretty good place to go out and raise a Series A. It'll be easier for you to raise a Series A because these references are going to come back so glowing, and you're going to know what to do with the money once you've raised it. Okay, so let's say you've now raised the money. Let me go back here. So you know you're ready to raise. So now the question is getting in the nitty gritty of timing that fundraise. So specifically, how do you think about sequencing the fundraise? And my partner Joe did a really good job explaining this, and so I've stolen a couple slides from him here. This is a rough fundraising process, and there's three basic phases. So you got to prep, and you basically need about a month to prep the core materials, and that you need time to iterate with your seed investors, do demo pitches with friendlies, just get feedback and make sure it looks beautiful, etc. There's also a process here where you need to line up your customer references and your management references, which is something most founders forget to do, but it's worth doing that in this phase so that when you press the button to go, you're really ready to go. Phase two is execution. This is when you're actually having the proper pitch meetings. And this will vary in terms of timing based upon, frankly, how hot the deal is. You want to be smart about sequencing it so that the VCs you're most excited about are not towards the end of the process, because you could get pushed to do something earlier and miss them. So you want to sequence it in a way that allows you to have folks that you're excited about towards the beginning of the process. And then lastly, the closing process. So once you've signed the term sheet, there's legal diligence, which generally takes about a month. So this is drafting all the docs and all the rest of it. So from the time you close the term sheet to the time the money is actually in the bank, budget about a month. Sometimes it takes 5-6 weeks. Sometimes you could theoretically get it down to 2 to 3 weeks, but roughly budget a month. So if you take this whole thing, it means that from the time you say yeah, I think I'm ready to start fundraising, to the time the money's in the bank, you need a budget at least 3 months. So keep that in mind. And then the last thing I want to talk about before we move into Q&A is what are some common mistakes that people make in fundraising timing specifically? And there are some surprising ones that I think are worth learning about. So mistake one again is a little bit more germane to years that are not COVID years, but it's worth keeping in mind, as we think about our post-COVID life. Sometimes people do launch a fundraise during holidays and vacations, which doesn't make a ton of sense, unless your deal is incredibly hot, where you've already built this relationship with the people that you want to raise from, and they're definitely leaning in, and they're around. One of the challenges of raising during Thanksgiving week or raising, during Christmas or what have you is even folks who might be pretty interested are going to be blocked out from participating. It's not going to be quite the tight process you want. Again, COVID's kind of throwing a lot of that out the window, but it's worth keeping in mind for future years. So mistake two, be very careful about raising during quarter end or close to quarter end. And there's two reasons for that. The first is that your focus should be on closing that quarter, right? And that's going to require a lot of your effort as the CEO. But the other thing is, if you launch a fundraise and there's another 3 weeks until the quarter's ended, and you've got a forecast for what the quarter end is going to be, the VC is often just going to want to see how that quarter plays out if they can. And if you miss your quarter, that's really bad, right? Just like everything else in life, the key to fundraising is under-promising and over-delivering. And if you can do that during the fundraise, then you get incredible, brownie points or kudo points or whatever the right phrase is. If I'm working with a founder and they've said, and it's 3 weeks before close and we're starting to get to know each other deeper, as part of the fundraise process formally, and they say they're going to hit $1 million in bookings this quarter, and then they come back and they're like, actually, we're going to hit 1.3. There are very few things that make a VC more desirous than it's this, the founder is consistently under promising, over delivering. This is something that Eric at Zoom consistently did throughout our time working together, and it's really delightful. So highly recommend being very careful about that quarter end. If you're going to raise around there, be very confident you're going to beat your quarter. Seasonality. So this is something that a surprising number of founders don't think about, but a lot of businesses are seasonal. And the seasonality can vary based upon what you sell. But if you're selling, sometimes if you're selling e-com software, there's a lockdown period where brands won't buy new software starting in the fall, because that's when they're actually executing. And so you're going to see a dip in that period versus a peak in the pre-periods. And so raising during that dip can be a bad thing, because the numbers are actually not growing as quickly. And vice versa, you generally want to raise during that strong period where you've got a little bit more ahead of you, and it's things are trending up. the VC will understand that the business is seasonal, but it's still just, better to raise when the business is strong. So milestones and metrics. You often have some big milestone or metric that you that is around the time of a fundraise, and you want to be really thoughtful about raising either right before or right after hitting that big milestone. And the before or the after basically depends on your confidence in hitting the milestone, to be candid. So, for example, as we have in the slides here, if there's a key channel partner who's going to help you sell your product that you're about to sign, and you're very likely to sign them, wait to do the fundraise until this person signs, and rather until this channel partner signs. And ideally, actually, if you could get some initial data on how that channel is going, and it's like it's limited data, but it's sloping positively. That's a really powerful thing, which is like, look at all the great stuff that's just happened, and it's too early to see exactly where it's going to go, but like it's, the initial part of it's inked. So that's another really powerful thing, because it allows the VC to forecast forward and say, hey, this is looking really exciting. I think the same thing can exist here with the quarter end risk, though, which is if you are touting some big milestone that you're expecting to happen during the fundraise and it does not happen, that can also kill the fundraise. So have confidence in that, but if you have confidence in one of these big milestones, some big product launch that's going to get a bunch of new users, then you plan around it, and fundraise accordingly. And then lastly, just DR cash date. This is worth keeping in mind. So if you take that 3-month fundraising cycle, you want to give a little buffer, obviously. And so you want to fundraise at least 6 months before you forecast your cash running out. And we say factor venture debt runway at 50%. So if you have venture debt and you haven't drawn it down yet, factor in at 50%. There are times where certain banks may not be as giving with the commitments that they've made. Even if you're headed towards a fundraise, because they might just be skittish and may not actually deploy their full amount of committed capital. So factor that in to be a little conservative. So about 6 months prior to your cash day is when it makes sense to start this process. So that's kind of the overview of fundraising mistakes that we've seen. The last thing I'd say is my partner Joe put together this really impressive suite of fundraising resources, which include pitch deck templates, financial model templates, reference templates. It's basically like a whole suite, a G Suite filled with diligence. And there's actually a whole enterprise VC CRM, which has hundreds of enterprise VCs that you can actually like sort by. So this is the link to it. You can also just email me at jake@mcap.com and I can send you the links to it. But that's another place to go if templates are useful as you're thinking about stuff. So I'm going to pause there and turn it over to Kirsten.
Great. Well, thanks, Jake. If you could stop the screen share, and we'll get that. And actually, maybe you can drop the link of those resources in the chat, and then folks can access it there. Well, thanks so much. That was actually really super interesting. As a friendly reminder, Q&A is open right now. We will not be monitoring chat, but definitely hang out there, network if you want. And we're going to try and get to as many questions as we can. I have some questions, but we already have a bunch. So I'm going to get started with the attendees because they're the most important. So this is from Russ Schweitzer. He says, what if you need more seed time/money before your Series A? Can you plan for a bridge round?
Yeah, so bridge is it's very case by case. So I would say that the excitement from a large Series A firm like Emergence or any of our peers to lead a bridge round is generally fairly low. And that's because you're still proving out a lot of stuff, and you're not like the buzziness around like, it's clicked in and you're raising this big round isn't quite there. So my recommendation when folks are saying, we've got some milestones that we think we need to hit before we are really at product market fit, is to try to go back to your existing investors and get some sort of extension. And that can be structured in all sorts of ways. You can, add on to the last round. It can be a note with a certain kind of uptick in valuation. But in my experience, the most productive use of your time when you're thinking about a bridge is to go back to the insiders.
All right. Okay, this is the next question from Yasser. And the question is, how long do we determine product market fit before going to a Series A round?
So the way I'm interpreting that question is how much time do you need to be in that product market fit zone? Like how long do you think you need to have had product market fit before you go? I think that's what question is. Is that right?
Yeah, I mean, I'm
Okay.
going to take a wild guess and say, yeah, that's
Okay.
that's
Cool.
right.
Yeah. So the reality is you want your users and your customers who have been using the product long enough to be able to sing its praises, and explain the impact that the product has had on their business. Ultimately, that's the lens to take. And again, I realize I'm speaking from more of a B2B perspective, but I think the same thing is actually true with consumer. You want your users who have been using the product long enough to be able to speak to, hey, this is how this has impacted my life. Because ultimately, one of the key questions that I ask when I'm doing diligence is, what was your life like before using product XYZ? And what is your life like now that you've been using product XYZ? And that delta, and frankly, the enthusiasm in their voice in describing that delta is a big determinant in whether or not I'm excited to lead the Series A.
So would you say that it's not so much a defined time, like a quarter or 2 quarters, but
Yeah.
really more once you have gleaned enough of these metrics to move
Yeah,
forward?
it depends on the product, right? Because sometimes like you could build a product that gets deployed and like all of a sudden it's changed people's lives completely, just because it's a new DevOps protocol that has completely changed the way DevOps operates, and you switched over one day, it's binary, and all of a sudden everything's different. Or it could be the case that it's a tool that requires a lot of behavior change, and it takes time to actually get people to change their behaviors, and that's going to take more time. So it's really thinking about how long does it take to actually change the way that my target customer's life looks.
Got it. Okay. All right. Well, we have a bunch more coming in. So what are your thoughts on raising a Series A as a first round for companies that need a larger investment to start off with?
Yeah. So I guess the first thing I'd say is that rounds names, like nomenclature, is completely arbitrary. So like, you could, I've heard some folks argue we should just number them and say like, this is the first time I raised money. This is the second time. So Series 1, Series 2, Series 3. I think what the question is like, can you raise a really big first round and call it an A or call it a seed or whatever you want to call it? But can you raise a big first round at a high valuation? There's two ways to think about the question. The first is, can you? And the second is, should you? So on the can front, you'll soon learn, right? So the folks who can are generally the people who've had a really strong track record doing something that VCs respect before. So you were a senior product person at a hot software company, and you're going to go out and start this thing that looks similar to the thing you built internally, and you're going to go productize it outside of the company. That's a situation where there's been enough de-risking just in the past of this person that VCs may say, you know what, it's worth putting in a lot of money now because the product they built and their track record suggests that the technology risk is going to be lower. Because ultimately, VCs are always trying to evaluate risk, and that risk metric is going to be lower if you've got a track record that's relevant to the thing you're building and impressive. So that's the can you. I'd say very few people can do that, but some people can. And on the should front, there's obviously huge benefits in doing that. You get a lot of cash cushion, you get a lot of room to play with. The downside to that is I actually think having cash constraints is useful for founders because it forces prioritization and focus. We're big believers in focus. If you've got 20 million bucks out of the gate, you may not actually have to focus as much, and you may end up, quote unquote, boiling the ocean a bit more with your product and ideal customer profile. So I think with rare exceptions, perhaps if it's a hardware startup or something else where you really need a large amount of cash to get the first product built, which again, I think most software companies don't need that cash. I don't think it's a smart thing to do, but there are situations where you just have to have that large cash to actually get. Kirsten and I were talking about, electric car companies. If you're building an electric car company, you probably do need to raise a lot of money upfront because that requires a lot just to get to an MVP.
Well, this is a good follow-on then. This is from Samit Jolly, and what's really the question's about what's the typical Series A round size in terms of valuation and amount invested. And I think you kind of addressed that a bit. It might depend, but maybe you want to elaborate a little bit.
Yeah. So, I mean, you can look at, there's a bunch of data on this, like in Crunchbase and PitchBook and other places. I would say anecdotally, so I've been at Emergence for about 6.5 years. And when I joined the firm, the average Series A was kind of like a maybe $6 to $8 million Series A. And, the VC, there would be somewhere, around 25%, 30% total dilution in that round as a result, with the lead VC taking about 20 to 25% of the round and then follow-on investors taking the balance. that ownership, is still relatively consistent, but it now is for higher checks, generally speaking. So I don't have the specific data in front of me, but anecdotally, Series A ranges now look like $8 to $10 million, or in some cases, if the company is super, super, has a lot of really strong metrics and the founder is really credible, it could be $10 to $12 million Series A. So it's shifted up for sure. The dilution is relatively similar, but you generally raise more cash for the same dilution.
Great. All right. Well, the next question is from Anurup Kumar. And what increase in user/market traction do you need to see between a seed and a Series A? You sort of talked about that a bit, but maybe you could define more what type of traction. What should those metrics look like?
Yeah. So it depends a lot on if you're selling a consumer product or an enterprise product, or, it depends a lot. So it's hard to speak in huge generalities. I'd say, classically the metric for enterprise software in terms of readiness to raise a Series A is about $1 million in annual recurring revenue. There are definitely deals that get done earlier than that, and there are deals that get done after that. The other metrics that we care a lot about are net retention. So that is basically, how much are customers coming back to your product and renewing, and also upselling. Generally speaking, you want your net retention number to be well north of 100%, meaning for every dollar you lose in terms of a customer that churns, you make more than $1 in upsells from the existing customer base. So you want to get to a place where you ideally have kind of that net retention positive behaviors, because that just means that the business, even if you sell no more business, you stop selling today, the business is organically growing. And that's a really good signal for the VC. And then the last thing I'd say that is a metric that we care about a lot is usage. That's classically been a consumer metric. But increasingly, I think enterprise VCs have realized that some of the most highly used products, are able to monetize really effectively. Zoom being a great example of a highly used product that's been able to monetize that usage. So Guru is another one. So we led the Series A at Guru. They had really impressive usage metrics. Actually, their usage looks roughly on par with Slack's today. And a big part of our investment thesis was that they're going to figure out a way to monetize this usage, and they have done so. So I'd say usage would be a third metric we care about.
Well, this is sort of a multi-part question, so I'm going to try to translate it here. This is from Arvind, and so basically he's asking how to show potential co-founders or senior roles who are yet to join the startup. So the question is, how does the equity or stocks change for such roles in case the fundraise happens immediately before they join? So I think it's a timing of hiring / the stock equity breakdown.
Okay, so the question would be, if you're trying to hire someone before a fundraise, how do you think about their options? Is that the concept?
Yeah, I think so. And then also how what if those roles, the fundraise happens immediately before they join? So then should you consider that in terms of timing and breaking up that equity piece? Yeah.
So two thoughts on that. So one is kind of the legal stuff, which I can talk a bit about, and then the other is just like the strategic stuff. So strategically, if there's a really impressive VP hire that you're planning to make and you think you can make, getting that person committed before the fundraise is a super important milestone. Back to the milestone stuff, like we take that as a really important indicator of your ability to attract great talent, which is a huge important indicator of your ability to build a great company. So if you can attract someone who's super impressive before the fundraise, then you should absolutely do it. I would say that a big part of the Series A investors' value add is that they help you attract great people. We have lots of folks in our network that we know, and we try to bring them in to meet you and convince them to join. And so most Series A companies don't actually have the executive team fully built out, so it's fine but having one or two is actually a really impressive indicator. From a legal perspective, there's something called a 409A. A 409A basically sets the value of the options, so the price at which the employees have to purchase their options when they exercise them. And by the time the deal is wired, basically when the cash is in the bank, you're required to have a new 409A. So if you were to gift options or grant options after the fundraise officially closes, then the cost for those options for that new employee is going to be higher. So if you want that employee to have a lower cost basis, then it's important to have them the options granted before the money's wired.
And actually, Arvind then later down qualified it a bit, he asked her it show to VCs question mark. So I think also, while that was amazing advice and really specific, I think it also might be a timing of, do you share this with VCs as well, that you're about to be hiring these
The answer is yes.
senior?
Like if yes, yes, because it's super impressive. Like that, what we're funding is the future. And if you've already built some of the future and you can show that to us today, that makes me more excited to work with you.
Got it. All right, well, we have 5 minutes left, so we're going to try and get through these. So here's another question. This is from Anonymous. If I'm raising, if I'm raising 500,000 for a Series 1, should I name it pre-seed or seed?
It doesn't really matter. I'd say like right now in the Valley, if you were to raise 500K, you'd call it a pre-seed. I'd love for us to get away from nomenclature and just, as this person said, call it a Series 1, 2, 3, 4, 5, 6, 7, 8. But the current nomenclature would be to call that a pre-seed.
Okay. Well, here's another question from Charette. I hope I got that name correct. I apologize. So he says, like you mentioned, a good time to fundraise can be when you have a key hire, which we just addressed. So I'm looking for a tech co-founder and also looking for seed money. Is this a good time to start networking with investors, or how should I go about it right now? So I guess I think it's like chicken or egg question.
Yeah. I mean, I'd say most seed investors, and I'm not a seed investor, I mostly focus on the A, but most seed investors are going to want to see the complete founding team before they invest, generally speaking. There's some, pre-seed investors that may just back the individual and perhaps help them find a co-founder. But I would say the vast majority of seed investors are going to want to see the complete founding team, because that's really what they're backing ultimately, because often the product is early. So that's how I'd think about it. I would prioritize finding your co-founder before raising the seed.
And then just to confirm, so you don't invest in seed rounds over?
We do on occasion. When we invest in seed rounds, we do it with the conviction concept I talked about before. So we don't do a passive investment. We really go all in and lead that seed and try to be a true partner to the company.
Okay. And another Anonymous, do you invest in software as a service / enterprise healthcare business in Africa?
We have not done much investing in Africa thus far. Kirsten and I were talking about beforehand, I spent some time working in East Africa prior to this career many years ago. We haven't yet, but I'd say as COVID has shown us, and frankly, Zoom has enabled, great businesses are being built everywhere right now. So I think geography constraints are less important. I will say that in terms of markets to sell into, the US is still the most robust market to be a buyer in terms of selling products. So if you're going to start a company somewhere else, you still probably want to sell into the US eventually.
Great. Well, unfortunately, this is pretty much all we have time for. And I didn't even get to any of my questions.
Talk offline, Kirsten.
Yeah. So before we close, what's the best way for founders in the audience to get in touch with you?
Yeah. So I'm on Twitter at I think at jakesaper.com, or not .com. That would be weird. At jakesaper. I will give my email address. Please use it judiciously, like email and give a lot of context, if it's helpful, but I want to be available to folks. So my email is jake@emcap.com, emcap.com.
All right. Be responsible with that email address.
Please be responsible.
It was given with trust. All right. Well, Jake, thank you so much. And to our audience, thanks for the questions. Thanks for joining. Don't forget to take advantage of the networking opportunities with other founders in Crunch Match. The session is going to close now. So please just go back to your browser to join the next session starting in a few minutes. Jake, thanks so much.
Thank you, Kirsten.